Hi, I'm Hedgeye's founder and CEO, Keith McCullough. Good news, the Hedgeye Investing Summit is back. We're super excited about this one as always. The first week of October, I'll be hosting in-depth conversations with the smartest minds in investing. Some of my favorite people like Liz Ann Saunders, Kyle Bass, and Grant Williams, just to name a few. We'll be discussing the big stuff, the big trends impacting markets in the days, weeks, and months to come. You don't want to miss this one. Registration's free. How good's that? You won't hear pro-to-pro conversations like this anywhere else, anytime.
I think when we get to the shortages of things out there, energy is key.
Yep.
And I am very much an environmentalist at heart. I launched a private equity firm this year that focuses on mitigating environmental impacts. It's a niche business that I love. And so coming from an environmentalist, what I'm trying to tell you is the virtue signaling of going from hydrocarbon-based fuel to alternative methods, whether it be wind, solar, et al., cannot be achieved in a few short years. The galaxy brains that are running things think we can just flip the switch, throw up some more windmills, some more solar, find some more places to put hydro up, and we'll just switch. It takes 40 to 50 years for new fuels to take over at least 30% of the global fuel world. When you look back to how coal entered the world, how natural gas entered the world. These things take multiple decades. And so what we effectively did 7 years ago is we said, less fracking, and now it's no drilling on federal lands, and now it's no more interstate pipelines. We just decided we're just going to turn off hydrocarbons. And what those people don't understand is hydrocarbon demand is inelastic. The world continues to grow due to the largesse of a lot of these central banks flooding the world with liquidity and growth. And now the world's about to reopen from COVID. And when it reopens, global demand for crude is going to blast right through, we think 105, 106 million barrels a day. And the crude complex can't possibly pump that much. So the same phenomenon that took the front end of the curve negative when there was just a glut with nowhere to put it, there's going to be a demand out there that can't be satiated by physical supply. So the front end is going to go crazy again. We are certain to see $100 crude in the near future. And those options have been trading in DEES 22 for $200. Now, I'm not buying those options, but they are trading, just to let you know. So I think other people are seeing what I'm talking about here. And let me give you some insight.
Did you say the December 2022 contracts at $200 WTI? I didn't see that.
Yeah. 1,800 of them traded just a couple days ago. You
didn't put that on the tape just so you could say that, did you?
I did. I did. No. I put it on Twitter. I put it on the Twitter tape. I did not. I was not the buyer of that tape. No.
I'm kidding.
No. But I do think that some inside baseball is a lot of the public money, so the mutual fund money, stopped buying energy stocks because of ESG, either mandate or discussions 6, 7 years ago. And then you still had big private equity, and you had investors that were global pension funds and endowments. Big institutional investors were still plowing money into the private sector of energy venture capital and energy private equity for development. And if you aggregate wholly owned companies that some of these private VCs and energy private equity firms have, they rival Exxon. Quantum Energy down in Houston, if you add all of their drilling rigs together of all the companies they wholly own, they're the second largest driller in North America.
Wow.
And you probably never heard of them before.
No.
The point being is that was a huge engine for maintaining our production levels in America, maybe growing them a little bit. And then now what you've seen just recently, even though pricing, now natural gas has gone from 2 to 6 in the US, oil has gone from 35, 40 to 80. And you should see more rigs popping up, more companies drilling, and you should see money being invested into the sector. And in fact, they're treating it like the plague. Some of those big institutional investors that have never wavered because they've made so much money with these private equity firms are now in the new private equity firms funds. They're disappearing. The top 5 investors are saying we can no longer do this. So it's counterintuitive. At this moment in time, the ROEs on these projects are so enormous, but there's very little money in the space. And in fact, it's running the other way right now, again, because we have virtue signaling and ESG mandates where these boards of even the big pension funds and the big endowments are just saying, sorry, our board's saying no more hydrocarbons. We need to do more wind and solar. Well, that is setting the market up for a crazy shortage of hydrocarbons this winter. So I think this winter is going to be very difficult. And as you know, natural gas tripling makes the cost of fertilizer almost triple, which makes the cost of food skyrocket even more. So you're about to see food prices continue to rip, and you're going to see wages move, and you're have shortages of truck drivers and shortages of this and that because people don't want to work anymore. You're going to have to incentivize them to work, which means you're going to have to pay them a lot more. So I think you're going to see a Q3 stagflation on steroids in the next 6 months.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.